welcome to this week's edition of MFB News. I hope everybody is fine and dandy and enjoying this wonderful autumn that we're experiencing at the moment. So here we are, another week, and this time we have a new government upon us. It'll be interesting to see how that shakes out now. I think I'm sure you're feeling very similar to me. You're feeling very kind of nervous, full of trepidation in terms of what a Labour government's going to mean for the landlord community. But likewise, we are where we are now. So let's just hope that actually there are some favourable changes that present themselves in the coming weeks and months. Now, in terms of what we're going to be covering off for you today, we're going to do our usual roundup on what's been happening with swap rates and mortgage interest rates. We're going to talk about criteria changes. We have a new lender who's entered into the limited company space. That's always quite exciting if you're really into mortgages like I am. And so I'll be sharing a bit more information about that with you. We're then going to talk about rental yields across the country and by region. And finally, we're going to talk about what has been classed as the new property hotspot in the UK. Okay, so first up, swap rates. And the good news is that the world hasn't fallen apart in that regard since the general election. So 2-year swap rates currently 4.394, 1 month ago 4.665, and 1 year ago 5.983. So month on month circa 0.3% lower, year on year 1.6% lower. So no matter how you're feeling at the moment in terms of where things are, the good news is that we are in a much better position than we were 1 year ago. Same sort of story on 5-year swap rates incidentally. So 5-year swaps 3.874, 1 month ago 4.145, and 1 year ago 5.220. So essentially what we've seen month on 5-year money is a step down of circa 0.3%. And this has really been kind of picked up by the lenders. So for those of you who watch this update fairly regularly, you will have noted that we've been mainly reporting pricing reductions. Nothing too exciting, let's be honest, but reductions nonetheless. So in terms of the last week, we've seen the mortgage works make rate reductions of up to 0.3%. So their 2-year rates are now from 3.69 and 5 years from 4.04. They've also reduced limited company pricing by 0.25%. So pricing here now starts from 4.84%. Now the mortgage works as a lender, they are trying incredibly hard to be able to lend to pretty much every single landlord on every type of property. So as an example, they can do HMOs, not big ones by the way, but small HMOs. And they can lend to landlords with larger portfolios, so over 10 properties, which is quite unusual for what we would class as more of a high street lender. Different products there for large portfolios, but nonetheless they can still help you guys. And then they're also able to lend to limited companies as well. And their pricing is actually very, very good here. However, the criteria is very restrictive. So things like there can be no more than 2 applicants on the mortgage. And because they take personal guarantees from all directors and shareholders, this means that the company can have no more than 2 directors and shareholders, which, actually for a large chunk of company structures works absolutely fine, but it does rule out also a large number of potential borrowers. They are looking at this at the moment, by the way. Things like if you were to be selling your home to your limited company, which lots of people will do if they decide they want to retain their current home and rent it out, but putting it into a company is more favourable from their kind of tax position. The mortgage works wouldn't be able to pick that particular transaction up at the moment. So while there's lots of good things that they do, there's also some real kind of limiting factors in terms of the kinds of deals they can pick up. But the key point here being their rates have come down, not by an insignificant amount, and they are a really, really large lender. So when these guys reprice, the market is forced to take note and review their pricing as well. So it's a really positive thing. Now, on the note of large lenders and rate reductions, we've also seen BM Solutions make reductions of 0.1% to their product range. Very, very small amounts of rate changes going on here, but it's a step downwards, and that's always very, very welcome. Virgin Money rates down by up to 0.12%. So their rates are now from 3.98. We've seen the Leads make reductions to their limited company rates of up to 0.5%. Now, it's not that the Leads have been suddenly got some sort of amazing way of reducing their cost of funds, bringing their cost down essentially by 0.5%. It is literally that they put their rates up because they were priced so cheaply, they were getting absolutely awash with business, so they put their rates up higher to kind of price themselves out, to slow down application levels basically. So they've now obviously seen things slow down. The level of business that they have across their desks is at a more manageable level, so they've taken a decision to bring their rates down to a more kind of appealing rate for new borrowers. Now, Paragon have made reductions to their rates, so they've made reductions of up to 0.25%. Another lender who people are watching very keenly to see what they're up to. It's a great news from them. We talk about Paragon often. You know, I'm a great fan of theirs. So individuals, limited companies, no maximum number of properties in the background, can do HMOs of up to 20 rooms, multi-units of up to 20 self-contained flats. They can do layered companies and all sorts. So really, really great lender, big rate reductions. And then finally, we've seen Kent Reliance reduced some new limited edition rates. So their 2-year fixed rates are now from 4.54 and their 5-year fixed rates are from 4.79. Please just note these do have those larger arrangement fees though. Now, with regards to Kent Reliance, again, specialist lender, so no maximum number of properties in the background, can do limited companies. One of the things that is relatively niche for Kent Reliance is the fact they only take personal guarantees from the directors of the company, not the shareholders, which means that this kind of allows for those companies where you might have some children as shareholders, as an example, or maybe one person who's a shareholder who is overseas. As long as they're not a director, that kind of can mean that that fits criteria with Kent Reliance. And there's lots of other great stuff they can do as well. So they're doing larger HMOs and multi-units these days, day one remortgages and all that kind of super stuff. So all in all, I think it's fair to say that things are going in the right direction, but it's going to be an evolution, not a revolution, in terms of pricing changes based on what swap rates are doing. Now, in terms of forecasts for base rate, I'm afraid to say that the expectation is now that we're not thinking there's going to be a base rate reduction in August. We are expecting it to be September now, but the fact that the money markets are pricing down on swap rates is a good indicator that they are kind of on the right trajectory to seeing base rate coming down definitely at some point this year. Okay, now we have seen a couple of bits of news in regards to criteria. So the first thing is that Precise have taken a decision to remove the option to use top slicing on personal name applications. However, what they are doing is allowing top slicing for remortgages as well as purchases if you're borrowing through a limited company. And this is quite an unusual choice decision actually. So top slicing is where the rental calculation that the lender uses as a matter of course doesn't quite work, so you're left with a shortfall in terms of the amount of money that you can borrow. So what the lender can do is then look at your own personal income and decide whether you have sufficient surplus income left over after your own personal expenses, your home mortgage, loans, credit cards, that kind of thing, almost as if you're looking at it as a residential mortgage for all intents and purposes. And then assuming that you have enough money left over to kind of cover the shortfall yourself, they can lend on that basis. Now, it's quite unusual. Most lenders will, those lenders who offer top slicing tend to do so for personal applications, but not for limited companies. Why is this? So I think predominantly, the reality is that with limited company lending, because the rental calculation is slightly more generous, we don't need to use top slicing on that basis. Secondly, it could be quite complicated because when you're looking at top slicing for a limited company, are you looking at the income for the company itself or for the directors? So it is an unusual move, but actually one that's quite good because actually there aren't that many lenders doing top slicing in the limited company space. So while moving away from personal top slicing is an unusual step, and I'm sure they have their very good reasons, actually bringing it into the limited company space with purchases and remortgages is really, really positive and kind of fills probably what is a bit of a hole there. So good stuff from Precise. Now, the other thing we've seen this week is Metro Bank move back into limited company lending. And I say move back into, this is their third incarnation of limited company lending. So Metro Bank are a bank essentially who you might have seen on your high street. They have very, very shiny offices. They're very, very dog friendly. That's kind of one of their sort of things that they play on. Now, in terms of their offering, when they first did limited company lending, they were a commercial lender that were able to do a bit of buy-to-let for limited companies. The second incarnation was more along the lines of just doing a buy-to-let mortgage for a limited company, but I have to be really candid about this. Their service wasn't very good and their criteria was quite restrictive. So fast forward to now, the third incarnation, and I think it's kind of almost like the second version back out again. So looking at the criteria, it's nothing racy at all. So just to give you the key points, maximum of 75% loan to value. They're going to stress the mortgage at 125% coverage, which, you know, for limited companies is absolutely a matter of course. They can accept up to 4 directors and shareholders, but these have to be the same people. And these 4 directors and shareholders have to own 100% of the company. So what that means is that you could have 4 directors who all own 25% of the company each. What you could not have is 4 directors who all own 20% of the company and the remaining 20% is owned by someone totally else who's not a director. So all the directors and shareholders totaling no more than 4 people need to be the same. Now, one of the things they are doing, which they stopped doing a while back during COVID, is that they are now allowing portfolio landlords with a maximum number of 10 properties, and that's 10 properties in the background, 10 properties with Metro Bank. The key point being that the maximum amount of debt can be no more than £10 million with Metro. And then finally, they're only lending, sorry about the dog, to SPVs, so no trading companies, nothing racy at all. Straightforward properties, no HMOs, no multi-units, and things like day one remortgages they're also not going to do. So what I kind of liken this offering to would be someone like the Leeds Building Society. So they are a high street lender who does buy-to-let lending quite well, and they're now looking to start lending to limited companies as well. But I think the key message for you guys is that what Metro Bank will be able to bring to the table is probably some slightly more competitive interest rates, which is really just going to kind of help bring more competition into the limited company lending space. Now, fleet mortgages are another one of those lenders who spend lots and lots of their money generating really, really interesting market research. So I think it's really important that we kind of talk about this, because it gives you a really good insight into what's going on across the country and potentially in your region as well. So according to the latest rental barometer that they have produced, all regions in England and Wales showed an increase in yearly rental yields. Now, looking at the chart, the areas which have experienced the biggest growth in yield year on year, so the North East has experienced a growth of 1.6%. We've seen Wales at 1.3% and the West Midlands at 1.4%. In terms of the lower performers, so still showing an increase but a much more subdued version, we have the Greater London at 0.8%, South West at 0.5%, and Yorkshire and the Humber at 0.3%. So these areas are still seeing a growth in yield, but actually just not quite so impressive as some of the other regions in the country. Now, Fleet go on to say that following the renewed optimism referenced within the quarter one barometer that they produced, the outlook during quarter two felt a little subdued. So continued volatility within the swap rate markets resulted in upward pricing changes from many lenders, don't we know it, which presented some affordability constraints for a number of landlords who are rolling off of 5-year fixed rates and looking to remortgage away from higher reversion rates. The general housing market also appeared more subdued, with flat house price growth expected to continue until the outcome of the general election was known, and the first of the long-awaited Bank of England base rate reductions was confirmed, which is now expected to be in September. So essentially what they're saying here is that no one's expecting the housing market to really kind of pick up back up in earnest until we get a base rate reduction, having got the general election out of the way. Now, they go on to say that said, the latest fleet debt market data reveals a surprising increase to the share of property purchase business received during quarter two, so how many purchase applications they're receiving versus remortgage applications. And this is increasing from the longer term trends of 30% to 42% of applications received during the quarter, as more landlords look to acquire additional rental stock to build their portfolios. Now, according to Fleet's data, rental yields across England and Wales averaged 7.6% in quarter two 2024, up 1% from 6.6% over the same period 12 months ago. It goes on to talk about rental yields by region. So within the North East, it's generating the highest yield based on quarter two application data, increasing 1.6% year on year, with positive increases to yields across all regions when compared to quarter two 2023 data, so 1 year ago. Increases to the North East region were closely followed by the West Midlands at 1.4% and Wales at 1.3% growth. Fleet data reveals the highest average monthly rent per property, which is £2,024, is generated within Greater London, followed by East Anglia at £1,594. Properties located within the North East typically see the most affordable rental stock, commanding a rent of £768 per month. So there you go. For those of you who are kind of thinking, we've got the election out of the way, I'm ready to invest. And actually, you know, there's a lot to be said for where we are at the moment. The house prices are, broadly speaking, and it does vary by region, but house prices have been flat, coming down in a lot of instances. There is some real opportunity around. We will expect to see mortgage rates come down now over the coming months. Like I said earlier, it's not going to be quick, but it is going to be a downward trajectory. And there is an expectation that the housing market will start to pick back up again once we see that first base rate increase. So essentially what it sounds like to me is there is kind of a window of opportunity for investment before house prices start to kind of recover. So for those of you who are kind of waiting to invest, hopefully first of all having some information on yields, if you're one of those investors who focuses very heavily on that, is useful. But actually just to kind of say that the expectation is that we are still going to see house prices start to tick up. We're going to see interest rates start to come down or continue to come down over the coming weeks, and now could represent a very good moment in time in which to think about adding to your portfolio. Okay, now continuing on with that theme of property investing, or something quite positive about investing in the future at the moment. There's been a new investment hotspot list prepared by a fast-growing UK property portal which is called On The Market. And it applies to the second quarter of this year, so April through to June. And it uses data which incorporates the first quarter of the year for comparative purposes. And what they tell us is that Bradford is the leading hotspot in the country for the second consecutive quarter, which is benefiting from the ripple effect as buyers have been priced out of Leeds, looking for neighbouring and more affordable alternatives. Meanwhile, Blackpool edged into second place. It was 5th in quarter one, and Rochdale stormed into 3rd place. It was 23rd in quarter one. 4th place, Plymouth, the only southern location in the top 5, has also seen a considerable jump from 22nd place in quarter one. Leicester is a new entrant in the top 5 from 5th in quarter one. So these are the cities where we're seeing kind of investment potential really increasing. Why those cities, I don't know. I don't know enough about what's going on in Rochdale, I'm afraid. Maybe if anyone who's watching this knows Rochdale particularly well, they can let us in on the secret. But actually these are where people are kind of getting really interested at the moment. The reason people are particularly interested in northern locations rather than southern, it's a yield thing, broadly speaking. So because of the yields being greater up north, because of the higher mortgage costs at the moment, we always see landlords, when things get a bit tight, start to really focus on yield, and you're always going to get the better yield unless you're looking at HMOs and multi-units up in the sort of northern half of the country. So overall in the market, it says the north-south divide is holding firm, with some of the most vibrant and cheapest locations in the north seeing the most heat in terms of housing market activity, and only one southern location making it onto the top 10. The portal says that none of this comes as any surprise after 14 increases in base rates since December 2021, followed by 7 meetings where the bank has voted to maintain interest rates at 5.25%. As well as higher borrowing costs, the post-pandemic shift towards working from home at least part of the week means buyers can consider areas further away from city centres, which tends to be less pricey. Other notable big movers in the index include Wakefield, which has jumped from 30th to 9th place, and Birmingham, which has jumped from 23rd to 43rd, so it's gone down. Moving in the other direction, demand in Wigan has cooled significantly, dropping from 2nd to 15th place in their rankings, while Liverpool has fallen from 11th place to 30th. Worthing, one of the few southern locations to be considered a hotspot, fell from 20th to 53rd place. The coolest hotspot on the list is actually Brighton. Now in the London boroughs, there's been less fluctuation than nationally and very little movement. Newham has entered the top 5 for the first time, moving from 10th in quarter 1 to 5th. Meanwhile, Hounslow dropped out of the top 5, moving from 4th in quarter 2 to 9th in quarter 1. And several, including Lambeth, Southwark and Merton, all dropped 4 places. So there you go. It's really interesting to see where the kind of real movement is happening in terms of housing transactions. And like I said, there's going to be reasons why people are kind of setting their sights in certain areas. But I think the key message for you as investors is that once again, if an area is being seen as more desirable in which to live, whether it's because of cost or whether it's for another reason, if you are thinking about investing in this kind of information, I hope it will be very, very helpful to you. And that's us wrapping up for this week. I don't know about you, but my son is on his first week of summer holidays. 2 months. It's been a long week already, and we're only on day 3. So for those of you who are staring down the barrel of the summer holidays gun, I wish you luck too. But as always, in the meantime, if you have any questions, we'd love to hear from you. 0345 345 6788. And as you guys are very, very aware, there is an abundance of information available on our website. I do hear a rumour that the sun might be coming out later on this week, and actually next week's looking really fine. So hopefully next time I see you, the sun will be blazing, and we'll all have our barbecues fired up, and actually feel like we're actually getting a bit of a summer at last. Until then, do look after yourselves.